As we all know, the markets can be very volatile. And I'm curious how you handle those downturns and fluctuations and what's your approach to risk management?
Absolutely. So, one of the things we like to go over with all of our clients is making sure we have a lot of conversations around their risk tolerance. And I think risk tolerance is something that has a little bit of ambiguity around it for most people because they're just kind of putting themselves into two categories. I'm aggressive, I'm conservative, or maybe I'm moderate, I kind of fall in the middle, or I don't know where to put myself. But they don't really know what they're saying I'm aggressive me too. Like, what does that actually mean in practicality? And are you actually aggressive? So I think really breaking down what these different risk tolerances mean is very important. And so if you're an aggressive investor, that means that you're comfortable watching the roller coaster of the stock market go way, way, way up and then way, way, way down. And vice versa. If you're conservative, you're not comfortable. You'd be the one white knuckling it on the bar and screaming your brains out as you're watching this thing rock up and down versus the person with their hands in the air that's like having the best time of their life. So it's important to know where you land, where you lie on that. And it's also important to know what accounts of yours are affected by swings in the market. So any account, there's account types that you can have, which is just essentially how they're going to be taxed. So you have 401ks, you have IRAs, you have Roths, you have a brokerage account. All of these different accounts are all going to be tied to the market if they're invested for you. Versus if you have cash in a checking or savings account, if you have life insurance with a cash value, if depending on the type of annuity you have, you may be able to get potential upside, but it might give you some downside protection. So it's really important to know that just because the account type you have does not have anything to do with what it's invested in necessarily. You could have an IRA that is invested in an annuity that it has some protection or it has some consistency in it for you. You could have an IRA that's 100% in equity. So just because the account type doesn't mean how that's invested or what that's doing for you. So it's first important to know what is your tax diversification? What is your volatility? How much exposure do you have on market volatility or systemic risk? So what's the most important thing about systematic risk is that you cannot market risk is you cannot diversify away from it. And that's really important to know. You can't just go buy more bonds or go buy more stocks or I'm going to do more international or I'm going to do a little heavier weight in the technology sector. That does not diversify you away from the exposure of the volatility in the markets. So it's really important first to know that. The second thing is how much stomach do you have for it? And third, how much can you sustain? What level of losses can your portfolio sustain? And then we work through putting these volatility buffers in place based on what the client can stomach. So some people, like I was talking about earlier, a woman who could not afford to lose $1 in her investment account, that was critical to her financial success, versus somebody who may be earlier on in their career and they can afford to see some losses or this, that, because they have a long time horizon to make up for the differences in their account. So we first plan on, when we go through a financial plan, we're looking at three different areas. First, protection, then savings, and then growth. And it's important for us to know that you have an emergency fund set up. Do you have an opportunity fund? So if something were to come up that's great for you, do you have the liquidity means to be able to go do that? Whether it's maybe starting a business or maybe it's even just doing something really nice, like, paying for, your niece's 16th birthday dress or something fun. Do you have kind of those things in place? Do you also have protection against a loss of income? What happens if you were no longer able to do your job anymore and you're 35? What does your life look like? Do you have anything in place for that? And are you only relying on an employer benefit that can go up in smoke in a matter of 120 days? So it's really important to know these things. It's also really important to think about where you're at in your timeline. As I said earlier on, you've got a long time horizon. You can afford to take a little more risk, be a little bit more aggressive. However, as you get close to the end of retirement and you're nearing those first beginning years, we're then going to enter what we call the fragile decade. And the fragile decade is the first 10 years of your retirement. And it's really important to think about that because if we look at historically returns, there are some years that are fantastic to retire in and some years were abysmal to retire in. Because your portfolio have taken such a substantial hit in the beginning of your retirement due to elements of compounding interest and how that ends up playing out over a long period of time, that ends up decimating their ability to sustain their lifestyle. Versus if after 10 or 15 years, they get a hit to their portfolio, because they've had such a long time of a high balance that's been compounding for them, that's where then they're going to achieve much better results, or at least statistically, they're going to have much higher chance of success of being able to fulfill and pay for the rest of their retirement. And that's why when it comes to when we're looking at retirement, we're looking at these different things, I don't always care what your rate of return is. I care about what the balance of your account is. It's all well and good if somebody else is achieving, 15, 20% returns. But if in 1 year they lose 30% of your portfolio, because that can happen when you're being very aggressive like that. If you look at Peter Lynch and the Magellan Fund, he had phenomenal returns, phenomenal average rate of return, but the average person in that fund lost money. So that's, again, kind of going back to the tortoise and the hare. They actually have an analogy called the tortoise and hare portfolios, where if you look at a higher volatility fund compounding over time, and you compare that to a lower volatility fund compounding over time, the lower volatility fund oftentimes does better because they're not getting hit with the big losses. And oftentimes, as you go out further and further into the higher the number of the loss, it takes significantly longer to recover from that. So if you lose 40% of your portfolio in 1 year, which is about where we were in 2008 at negative 37, it is going to take you over 60% return that is required just to get you back to where you were. That takes years. So in 1 year, you can turn your portfolio upside down to then have it take you years and years to get back. So that's where it's really important that we're looking at different strategies, whether it's through tax loss harvesting, if it's through making sure you have a floor, making sure you have a stop loss in place, whatever the thing is to make sure that you're not going to be putting yourself into too much of a risky position. And I think that's another issue, is like the big myth about the big business exit and just putting all your chips into that basket and being like, well, I'll be good for retirement because I have this big asset on my balance sheet that I'm going to be able to cash out. And that's going to be my strategy. And that's just a bad bet.